What if I told you the difference between retiring rich and working until you can't stand is not about picking the perfect investment? It's about avoiding the trap that kills most investors before they even start. I'm talking about the ETF maze. Thousands of tickers, each one promising dividends, growth, or safety. I've seen people spend months, sometimes years, comparing charts, running endless what-if scenarios, waiting for the perfect time to buy. And you know what happens? They don't buy anything. Their money sits there, slowly losing value to inflation while the market keeps compounding without them. I know this because I was one of them. Years ago, I had my first $10,000 saved up. I thought I was being smart, researching every possible fund, reading every article. But here's the truth I wish someone had slapped me with. Complexity is the enemy of wealth. The more moving parts, the easier it is to freeze, to panic, to do nothing. So here's the promise of today's video. We're throwing that mess out the window. I'm going to give you a portfolio made up of only 5 ETFs, all from one provider, all designed to cover every core part of your financial life: income, growth, diversification, and stability. A portfolio you can understand, stick with, and actually have a shot at building serious wealth from. By the end of this video, you'll know exactly which ETFs to use, how they work together, and how to adapt them to your age, goals, and risk tolerance. This isn't theory. This is the same framework I'd hand to my younger brother, my best friend, or anyone I care about who wants to break out of the ETF paralysis and finally start building real long-term wealth. Why one provider can be a game changer. When most people start investing, they scatter their money across different brokers, fund companies, and random ETFs they saw on a list somewhere. It feels like you're diversifying, but in reality, you're creating a messy, hard-to-manage portfolio. You don't really know your true risk, your fees are all over the place, and rebalancing turns into a spreadsheet nightmare. Here's what the pros know. Simplicity isn't just easier, it's more effective. Choosing a single reputable provider like Charles Schwab brings 3 huge advantages. First, ultra-low fees across the board. Every fraction of a percent you save in costs is more money staying in your account. Compounding for you, not for Wall Street. Second, seamless integration. All your holdings speak the same language, making it easy to track performance and rebalance without jumping between platforms. And third, a consistent philosophy. Schwab builds their ETFs with disciplined, transparent rules. No chasing fads or loading up on hidden junk. When you use one provider for your core portfolio, you eliminate a ton of decision fatigue. That means you're more likely to stick with your plan. And sticking with your plan is what actually builds wealth. The 5 building blocks. Now let's break down the 5 Schwab ETFs that can form the backbone of a rock-solid portfolio. Think of these as your core tools. Each has a specific job, and together they can handle almost any market condition. First, SCHD, the income engine. SCHD is your steady paycheck generator. It invests in about 100 U.S. companies with a proven track record of paying and growing dividends. These aren't risky, high-yield traps. These are strong, profitable businesses with solid balance sheets. For someone who wants cash flow without giving up quality, SCHD is a cornerstone. Second, SCHG, the growth powerhouse. SCHG is where innovation lives. It focuses on large U.S. companies with the fastest expected growth in earnings and revenue. We're talking about market leaders, the companies shaping the future. This ETF can be volatile, but over decades, it's a serious engine for compounding your wealth. 3. SCHB, the U.S. economy in one fund. SCHB owns virtually the entire U.S. stock market, around 2,500 companies from giants to small caps. It's one of the simplest, lowest-cost ways to bet on the long-term growth of the American economy. If you want broad exposure without picking winners, this is your one-and-done U.S. core. Fourth, SCHY, global dividends and diversification. Most investors are guilty of home country bias, putting almost everything into U.S. stocks. SCHY helps fix that by investing in quality, dividend-paying companies outside the U.S. Different countries, currencies, and economic cycles give you true diversification, which can smooth out the ride when America hits a rough patch. 5. SCHZ, the stability anchor. Stocks are great for growth, but when markets crash, you need a cushion. SCHZ invests in high-quality U.S. bonds, from treasuries to top-rated corporates. Its job isn't to make you rich. It's to hold the line, reduce volatility, and give you a source of cash to buy stocks when they're on sale. Together, these 5 funds give you income, growth, diversification, and stability, the 4 pillars of a lasting portfolio. And the best part? You can adjust the mix based on where you are in life, which is exactly what we'll get into next. Building portfolios for different life stages. The beauty of these 5 ETFs is that they're flexible. You don't need to reinvent your strategy every few years, and you just adjust the mix to match your stage of life and risk tolerance. Let's start with the young aggressor, ages 25 to 35. At this stage, time is your superpower. You can ride out crashes and take advantage of decades of compounding. That means leaning heavily into growth. A smart allocation could be 50% SCHG, 30% SCHB, and 20% SCHY. That's a 100% stock portfolio. Aggressive, yes, but designed to capture maximum upside over the long haul. Next, the balanced builder, ages 40 to 55. Here, you're still growing wealth, but you also want a little defense. One example, 40% SCHB, 25% SCHG, 15% SCHD, 10% SCHY, and 10% SCHZ. This keeps you 90% in stocks for growth, but adds a bond allocation for stability. Finally, the secure and steady investor, age 55 and up. Now, the mission shifts from maximizing returns to preserving what you've built and generating income. Think 30% SCHD, 20% SCHY, 30% SCHZ, 10% SCHB, and 10% SCHG. You're still keeping a little growth exposure, but half the portfolio is in income-producing assets and nearly a third in bonds to protect your principal. No matter your stage of life, the framework stays the same. Income, growth, diversification, and stability. You just change the dials. The why behind this strategy. Here's the thing. Building wealth isn't about predicting the next hot stock or timing the market. It's about creating a plan you can stick with through bull runs, bear markets, and everything in between. These 5 ETFs cover almost every base an investor needs. They keep costs incredibly low, they spread your risk across thousands of companies and bonds, and they free you from the stress of constantly chasing the best investment. Most importantly, they help you avoid the 2 biggest portfolio killers: panic selling in downturns and endless tinkering that derails compounding. The reason this works comes down to discipline. When you understand what you own and why you own it, you're less likely to abandon ship when things get rough. You're not making desperate moves based on headlines or fear. You're following a proven long-term plan. And in the end, that's what separates the people who talk about financial independence from the people who actually achieve it. Action steps to start today. All right, now that you know the framework, here's how to get moving. Today, step 1. Open a brokerage account with Charles Schwab if you don't already have one. It's free and you can buy all 5 ETFs without paying trading commissions. Step 2. Decide which life stage allocation fits you best: young aggressor, balanced builder, or secure and steady. If you're in between stages, adjust the percentages slightly until it feels right for your risk tolerance. Step 3. Fund your account and start with whatever amount you have. Don't wait for the perfect time to invest. It doesn't exist. Use dollar cost averaging. Invest a fixed amount on a regular schedule, whether the market's up, down, or sideways. Step 4. Turn on dividend reinvestment. This way, every dividend your ETFs pay automatically buys more shares, accelerating your compounding without you lifting a finger. Step 5. Rebalance once or twice a year. This just means adjusting back to your target percentages if one ETF grows much faster than the others. Schwab makes this process simple and it takes minutes. That's it. No complicated stock picking, no endless research rabbit holes. Just a clear, disciplined system. Here's the truth most people won't tell you. You don't need to be a market genius to build serious wealth. You just need a strategy you understand, the discipline to stick with it, and enough patience to let time do the heavy lifting. Every single dollar you invest today is a worker you're hiring to earn more dollars for you. Some people never hire those workers. They talk about someday until it's too late. Others start small, stay consistent, and wake up one day with a portfolio that can fund their freedom. So the question is, which person are you going to be? If you're ready to take control of your money and let it work for you, start with these 5 ETFs. Build your base, stick to your plan, and watch what happens over the next decade. This is Mark from Dividend Hustle, helping you invest smarter, grow faster, and hustle your way to financial independence. If you found value in this video, hit that subscribe button so you don't miss the next strategy that could change your financial life. Your future self will thank you.